This example begins with a sizable rebound in an ongoing downtrend. Since the recent uptrend is essentially a series of 3 methods rising candle patterns, a Fibonacci retracement can help identify key levels and ranges in the absence of any recent swing points. Just to be extra correct, drag the highest point of the Fibonacci retracement to the highest points reached by the rebound so far. Essentially, we want to highlight this range from roughly 27 to 28, which has historically been quite influential. A wider resistance range can also be identified using Fibonacci extensions based on the range of these recent downswings, which were themselves bearish retracements, basically to outline that range at the top of the last bearish continuation. Using the less common 1.272 and 1.414 levels can help provide more short-term detail in the mid to upper 20 range, as can using a trend-based Fibonacci extension around these first few downswing points. Now, with the return to stronger bullish movement, fan lines from the Fibonacci speed resistance fan can help provide detail on future resistance and the trajectory of this emerging uptrend. The fan is easily based on those first few upswing points of the trend, and in terms of resistance, we pay attention to those areas marked by intersections with the horizontal Fibonacci levels, and of course the 27 to 28 range. When the chart begins dropping again, we do the same except it's in the context of support, and the angle of the trend lines can help predict possible short-term trend lines for bullish retracements that may not even contact horizontal levels of resistance. Given a strong sell-off like this, these areas can still be breached in the short term. And if the market is indecisive, we may just see flatter movement instead of bullish retracements following the angle of these fan lines.